You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Please welcome Bill Ryan, Director of NYSE.
Hey, I'm back. Well, we're trying to save time, too. We're a little late, but we're still on time. Don't worry about it. So good morning and welcome back. I hope everyone had a great night last night. We saw some pictures. Mummy Mountain looked like it was a good time for everybody. I hope you had a good time. So one reminder, please download the conference app. We went over yesterday how to ask questions. Please do so again today. Ask those questions. We had a great response yesterday. Had a lot of questions come in. Sometimes the moderators don't get to everything that the questions that come up, but we had a lot of great questions yesterday. So thank you for those to you who asked questions. So how did the option business do last year? I'm sure we all know how we did it at our firm and how we did it ourselves, but what about the overall business? Do we really know? Well, we have a man with the knowledge and the numbers coming up, so please welcome Henry Schwartz. Where's Henry? President of Trade Alert. Thank you very much.
Good morning, everybody. I am the man with the numbers and the knowledge, I think. So thank you for coming, and I was honored to be invited to do this for the second year. Until I saw that it was 8:15 in the morning, but I'm still honored to be here. I think that as our market evolves and becomes more and more automated every year, things like this are crucial. I mean, this is where you get the face time with people. You can spend months trading or building systems in a room with no windows, and this is where you actually get to see people and exchange knowledge, and I think it's a crucial part of things. So we're going to talk about the state of the industry. I'm going to try to save time for questions at the end. If I don't get to them, then find me later, and I'll be happy to answer them. State of the options industry, if you pay attention to the stories in the journal and that have been in the press in the last few weeks, it sounds kind of bleak. And I was really kind of offended at the tone that the journal, which obviously is fake news, put into that story about market makers fleeing the business. I focus, and Trade Alert focuses on data, turning data into information, quantitative, qualitative information. We're going to look at some numbers, and I have a much more optimistic view on how things are going and where things are going. So let's take a look at things and see what we have. For those of you that saw this last year, I've updated slides, and I've tried to add a few new things. If you look at the long-term growth trend in our business, the picture hasn't changed, obviously, very much. That exponential growth that came after the launch of the OIC in 2000 is kind of a distant memory. However, we're holding at around 4 billion contracts a year. And what's interesting, and we added, you can see on there, MIAX Pearl launched this year, so now we have 15 exchanges. That's the big difference. My numbers project an uptick in volume this year, which the journal kind of ignored. And last year at this time also looked like an uptick in volume. The first 4 months of last year were actually about 3% busier than the average daily volume for the rest of that year. But the way things look now, we do see an uptick of about 2% in the total market volume. And when we look at the last decade, okay, you can see the 2017 estimate on there. What's encouraging to me about this slide is that we actually see single stock taking a little bit of a tick up, all right, which is historically, for the last few years, been the kind of the sore point. That volume has been dwindling while the ETFs and the indexes have kind of taken the lion's share of the attention. There's another really important thing to think about in terms of this volume. Last year, for the first 4 months of the year, volatility was much higher. VIX was in the 20s for part of January 2016, February 2016. And everybody knows that volatility leads to volume in our business. And so if we're holding steady or even looking like volume is ticking up a little bit with a volatility, a VIX of around 12 or 9, that's actually really encouraging. And there's another point to think about in this volume, which I'm going to give credit to Boris Ilyevsky, who's not here this year, and I promised I would mention him because he helped me out with these slides, and he, as I think probably most people here know him, brought a lot to this business in his years at the ISE. But you also have a situation where the market is up 25% in the last few years, right? So notional volume. He actually asked me, he's like, do a chart in notional volume, not contract volume, but volume in notional dollars, which pretty much goes up straight with the market, right? His theory, which I think is really interesting, is you have a situation where when the market is up and higher and higher and higher, you have a certain segment of traders that are not going to increase their size with that. In fact, they're going to go the other way, right? If Apple is at 70 and you like to sell puts, you're not going to sell as many when Apple's at 170. So there's kind of there's a pressure on volume that goes the other way, right? So it's actually really kind of interesting. I'd love to kind of dig deeper into the data, because if you go, I was at SIBO Risk in March, and big focus there was on the Kelly bet sizing criteria, which would be the other way, right? If you have more wealth to work with, your size should be going up. So you have kind of two forces happening at the same time. But I don't look at the volume and say this volume is terrible. There's days where you scratch your head and say, wow, we barely traded 12 million contracts. But to see this kind of volume when volatility is at decade lows, actually is a good sign to me. Looking at open interest as kind of a measure of how much activity, how much hedging is going on. You can see it's really very, very stable. The peaks there are kind of the year-end hedges that tend to build up. Not a lot of motion there. But this is also, you can also read this, and I'm not trying to spin everything positive. But when you have the same amount of open interest and you have notional, you have the market up 10, 20% over a few years, that's actually a positive sign too, right? So that kind of goes against the concept of people shrinking their bets because the market's at a certain level. The growth of underlying instruments, okay, barely nudged from last year. I believe a couple of indexes dropped off the board. Well, I actually like the fact that the number of underlying instruments has kind of slowed down, because as you heard yesterday, part of the challenges facing participants in this market is this proliferation of everything, right? So for that to be kind of leveling out is kind of a stabilizing factor. It means that your costs of interacting with this market are not automatically going to go up. Contract growth. This has been updated to now. And you actually see I think yesterday Paul mentioned a million strikes. There's not a million strikes. He's being pessimistic there. There's about 900,000 strikes. But there are, but that's also stabilizing. Is actually ticking down a little bit. So this is healthy in that we're seeing things that didn't work, or that start to either be delisted or even just the exchanges to kind of be a little bit more conservative in what they list, right? For years there's always just been a kind of listed and see what happens type of mentality, because for the exchanges it doesn't really cost anything to list a bunch of new things, but it does cost the industry, especially when you get to these levels where it's such a challenge to actually manage all these things. So I mean, finally killing minis was a good example of something like, look, we tried it for a while, it didn't work, let's get rid of it. Exchange growth. So this is a different slide than last year for sure. Last year, although NASDAQ had bought, no, SIBO had bought, which merger was done last year already? NASDAQ and ICE was NASDAQ and ICE had been done, but not closed. So last year there were 7 exchange operators on this slide. Now, in terms of, everybody talks about, oh, there'll be some consolidation. We're getting it, okay? You still have 15 individual exchanges. Personally, I've been asking around, even at this conference, like, what would an exchange operator ever wind down an exchange? And the people I've talked to said, no, there's not really any reason to. I don't personally see the point of operating more than one maker-taker and one payment for order flow type of exchange. Those market models are entrenched and kind of meet the needs of the order flow providers, which is who, in the end, everybody's really trying to please. But I don't quite see having 2 maker-taker exchanges if there's really no difference. It doesn't seem to make a lot of sense to me. Similarly to delisting things that just don't trade after some amount of time, I would hope that, especially as things are kind of settling out in the exchange operator landscape, that people can step back and say, okay, let's, if there's something about this exchange that's innovative and unique and fills a need, great. But at some point you have to look at it and say, okay, this is not working. The market share is pretty, relatively evenly broken out, maker-taker versus payment for order flow, and that's definitely the state of things. That seems to please the sources of order flow, the best. Market share per exchange, you can actually see Pearl in the very top right corner is a little teeny tiny red blip because they just started up. This is all 15 exchanges. This is kind of how they've been doing over the last 10 years. Relatively even. You kind of see a little bit of squeeze on a few of the names. But what's interesting is all I did here was recolor by exchange operator, right? So the orange is now the NASDAQ family. The blue at the bottom is the CBOE family. And here it becomes a little bit more clear that there really is some pressure. The big guys are squeezing out some flow, some market share from the little guys, and it's something it's something to pay attention to, that'll be interesting to see kind of how that plays out. Market share for April. The slide on the left is all 15 exchanges. You see the slivers for some of the either new exchanges or exchanges that really haven't found any traction. CBOE with the biggest market share. This slide includes indexes, and then when you aggregate it by the operator, you see CBOE 44, NASDAQ 36, and then the NYSE ICE family 12.5. And this is not, as I said, that CBOE and NASDAQ chunks have grown over the last year, but not by more than a few percent. If you take indexes out of the mix, it's a totally different picture, especially on the operator side, right? So now it flips. NASDAQ is now the dominant in terms of contract volume on the non-index products. So you definitely have a bifurcation in terms of these index products versus the single stock and ETF multi-listed world, and that's I don't see that changing. The next slide last year, I believe, was the market maker slide. I'm going to back up because I don't want to show you that yet. Which showed basically different sized dots for the market makers in our industry. I actually got rid of it because, there's a point to it, and it plays into kind of transparency, which I think is kind of one of the challenges in our market. 15 exchanges, that's logistically is challenging, and there's ways that participants and vendors and routers kind of tackle that challenge. But the number of market makers, the liquidity that's available in the marketplace, is what the journal, and even the comments from Wolverine a little bit after that were concerned about. And what I'm concerned about is the transparency in trying to figure out who the market makers are, and that's why the slide's not there, because there are exchanges that will say, yeah, here's our list. Here's the primaries, here's the secondary market makers, here's the specialists, however you want to, whatever the terminology is for the certain exchange. Currently, you can't really get that information from all the exchanges, so I didn't want to put it up flawed, and so that slide is gone. But I would hope for next year that there's a little bit of pressure to kind of open up and improve the transparency in what's going on in our markets. This is last year I called it the Death Star because it was round. This year it came out square, and I don't even really know why, because it's an R script that I wrote. You see Susquehanna in the center of things, 15% of the open interest. That's an increase. They have gotten bigger in terms of percentage of open interest. This is as of December 31st, which is the last time that all the filings are complete. What's interesting is, although they've gotten bigger, and a lot of people will just comment, oh well, now we just have 4 big market makers, and everybody else is just gone. The top 10% actually kind of the breadth widened out a little bit. So the top 35 participants, okay, most of those are liquidity providers / market makers, are now 80% of the open interest. Okay, a few years ago it was only 27 names that were that concentration. So that's a healthy sign, that it is getting kind of spread out a little bit. If you look at the kind of count of institutional filers with options, and so this slide is similar to last year, but I enhanced it a little bit this time around to show the churn. Okay, so how many funds or filers are dropping out, and how many are adding each quarter. So the green is new filers that were not that didn't have a filing with options on it in the prior 2 quarters. The red are filers that are disappearing. So, and this is kind of important because if it's the same 700 filers quarter after quarter, it kind of shows you there's no real new blood coming in. This actually shows that the average add and drop is around 105 per year, and the average drop is around 92 or something. So we're picking up around a dozen new filers each year with options. That's why it's trending up. Certainly a good sign, and listening to Frank talk about the Option Institute's outreach and trying to kind of treat these customers right. This is a way to see obviously who's trying things out, and in a big enough sense to have to file a 13F. The other thing that I would add, it's important in terms of, I think this is underrepresenting because there's no shorts. 13Fs are not, they're not required to file short option positions. I would love someday if the 13F filing rules were tweaked to include some of the things that they don't, like shorts, like the index positions, things that you would think make perfect sense. But the more you hear about overriding overlays, and it's in my experience that's definitely a segment of the market that's picking up in activity, right? It's also been probably profitable over the last few years. So you don't see an account that is just short options. So I would argue that this is bigger. There's a universe out there of premium sellers basically that are hard to see, and I wish we could find them. Concentration. This has not changed much from last year. The top 3% of the instruments trade 80% of our volume. That's just how it is. It used to upset me, and you can get into a long argument about it's the chicken and the egg, and the markets are too wide, so people won't trade them, and the markets are wide because there's no volume. But this is what it is. It's the hyper liquid products. Once you get out of the top 200 names, there's very little volume. About 2,000 names have average daily volume under 10 contracts. So that's half of the listings. I think that it would be, when the load of quoting, 900,000 contracts is a significant factor in people not coming into this business or, even possibly leaving this business. I think it would be helpful to talk about delisting some of these things, or at least coming up with a system so that you can delist them until you need them. The truth is, an exchange can usually get options listed within 6 days if they meet all the criteria for listing. I don't know why we couldn't come up with a pilot program that would get you a same-day list if a name becomes a target or something like that. Premium concentration is even more extreme. So in this market, SPX options are 45% of the daily premium, almost $2 billion a day in SPX. And then, ETFs and single stocks is the rest. Again, it just kind of illustrates that you got two very different markets. One of a little side effect on SPX is because so much trade's tied to combos. You get kind of an extra boost there because the hedge is usually in the product itself, or in a lot of cases. But a pretty extreme configuration of things. Non-standards, the weeklies, the quarterlies, the monthlies continue. I kind of, if you only looked at the moving average for the last 2 years, it's pretty much flatlined. Okay, so weeklies are now 35% of the average daily volume. There's days it's 50% of the volume. So you're still in this situation that where you have a concentration in a handful of names effectively, and then within that you have a concentration in the weeklies, and most of the time it's the first few weeklies. That's what trades. That's what customers like. That's what the banks have become comfortable with. I think that it's obviously as the liquidity moves to the front, those back end markets widen out, and we're working on some analysis of kind of just how wide it is to trade the back end. But it was nice to hear yesterday in the exchange updates that I think Patty mentioned a program where they're kind of prioritizing market makers that are on the BBO for one of the responses. And I think it's important to consider the overall picture in liquidity and when the exchanges are coming up with modifications and innovations and new rules. Complex orders, similar to last year. The orange is the index products. The blue is the single stock and the ETF world combined. About 30% of the average daily volume is in complex orders. And you heard yesterday the exchanges that don't have complex order books are finishing them. The exchanges that do are enhancing them, whether it's from smart risk parameters, so you can't go pay $5.10 for a $5 spread, to the things that like the synthetic legging of the legs out in the real market. So it's still kind of one of the most exciting areas of the market, and even as it was mentioned in the millennial panel, spreads are kind of an area of growth, and because they've become so much easier to trade, and there's still more distance to cover for that, but it's a big piece of success. Complex order activity. It's 65% of the ISE volume is complex. Almost half on the Philly and the SIBO. So it's huge. It's crucial, and it's an area where there's still all sorts of innovation to continue with. And so that's another slide that I think is a big positive for this business. Flex options, which are kind of one of my little pet favorites, not as successful as I thought they were going to be. Last year they were actually active in the first quarter, and they tailed off, and there was a downtick in flex. This year, that forecasted flex volume is actually kind of meager. and it's better than 2014, it looks like. But I think that that's also, and maybe with some of the consolidation that's happening, there's a lot of room for improvement in Flex for sure. There's still plenty of open interest, and as you see, like in the pie chart, that Mondelez chunk of 21% is tender related, I believe. So when a big account runs out of position limit room in the listed, they can go do it again in the Flex, and then they can go do it again in OTC. So Flex does serve a purpose there, and like I said, I think that streamlining the access for customers to Flex could go a long way to boosting that volume. Bid offer, some market quality. This is, I have a few different stocks here. We're looking at the quoted spread and the executed spread, okay? So, something like Apple, every time I look at this slide, and I think when 2008 rolls off, I'm just going to make it an 11-year slide because it's amazing to see what the bid offers looked like in 2008 during the crisis. But you see something like Apple, basically, the quotes, narrowing down. Everybody knows Apple's, basically a penny wide in most of the contracts that anybody's going to trade, and that's exactly what you see. Very stable. That's kind of one of the reasons that it's so heavily traded. Something like Tesla, much more volatile, and something like this where the quoted spreads are widening out. The effective spread, the spread that the customers are paying, is not moving as much. But to me, this is, I guess, the biggest challenge that this industry needs to pay attention to is quotes widening out for structural reasons. This whole concept of like, well, gee, I don't need to compete on a nice tight quote because I'm going to respond on an auction. So I'm going to make my market 50 cents at $2, except my true market is 85, 95, and that's what you're going to get if you go into an auction of some sort. That has a really nasty, externality, which is you lose the incentive to compete on quotes in the lit market, which Ivan mentioned at the very beginning. That's something that this market was built on, right? People tripping over each other in pits to make sure that they team-eat each other until they got to the highest price they would possibly pay. Doesn't happen nowadays in most cases because you can make a big fat wide spread and respond in an auction, and you basically talk about a two-tiered market. You've systemized a two-tier market. Pulte is a cruddy name. I think it's in the, I think it might be around, I don't even know if it's in the top 100. But similar to Tesla, it's just the quotes are getting wide and getting untradeable. And, you have to keep in mind, and, yes, there's price improvement, and you might be $2, at $2 at $4, but if you put in a $4 bid, you're going to get filled at, at $3.05, and you'll be like, wow, that's cool. It doesn't reflect it doesn't handle the people that look at this quote on the screen and go, $2, $4, next. They're just not, the confidence was mentioned yesterday in a bunch of presentations, and building a wide quote, even if you can get filled in the middle because of a price improvement or because you're an institution and you get a big bank that will commit capital near the middle, it does not instill confidence. So I think that's a challenge. So to summarize, volume, I don't have a problem with the volume, especially because the volatility has been so low. Fragmentation is a challenge. It's a cost. It's a huge cost. I used to work for Blair Hull, so I'm in touch with him. And at one point a few years ago, when I asked him what they were up to, he said, "Oh, well, we're high-frequency futures trading." And I said, "Why not options?" And he looked at me. He said, "We wouldn't." He said, "I wouldn't spend $25 million a year to build and run an options market-making business." And then Wolverine threw out a $50 million a year number for technology spend. And yesterday, Hung Sup asked me, like, well, did you ever add up what it even cost to get memberships and connectivity to these 15 exchanges? And I haven't done it, and there are some savings in terms of a single line will connect you to, I believe, ISC, Mercury, and Gemini, and I'm not too sure about the other NASDAQ exchanges, but that fragmentation is a big cost. So I have a question, and I don't remember what the other points. Oh, they're still there. Oh, that's good because the question's on here. I'll quickly go through these, and I'll try to get the question. Fragmentation and costs go together. Commissions, I was at SocGen last week, and a sales guy was basically showing me that about half of their orders now are break even. I mean, the customer pays $1, the bank has to go pay a take fee, depending on how they access the market. He's like, these trades are not profitable in a commission sense. It's something to kind of keep in mind because it is one of the reasons that that the broker-dealers do this business. Participants, I think that we need to do everything we can to help the market-making community or some sort of liquidity providers get into this business. One of the interesting things is although the market makers making markets on 15 exchanges, maybe soon to be 16, has dwindled. When I go to Chicago and I run into new market makers, and like, you guys are market makers? Yeah, we quote, usually SPX and SPOOs or something. And so it's interesting because that becomes an entry point for somebody to start market making and kind of figure it all out and basically build up some capital and then tackle the multi-list world. So that's something to keep in mind. Competition between exchanges, it's a fact of life. I just think that, at least in this for-profit exchange world, I think that it needs to be looked at more than just like, okay, how can we steal some order flow from these other exchanges, right? If it's just the same pie and it's not getting any bigger, it doesn't really benefit all of us together. So I think that competition is healthy. I think that things just need to be looked at in terms of what are the side effects. A lot of what I heard yesterday on the exchange updates are enhancements to types of QCC orders and things that that help internalizers internalize. And I know of more projects at a few banks where they're trying to internalize more order flow. And I get it. Everybody's trying to kind of do as well as they can off of the resources they have. But it would be, I think we all realize that if we get to the point where, where it's like Europe, where the listed markets are basically just not lit. There's no quote at all. You go to, institutional clients can trade through a bank, and maybe something filters into the listed world. It doesn't bring anybody new into the business. And transparency, as I said, I think that I think this business could use more of it. I think that there's a balance there. Obviously, you're trying to keep the customers that don't want transparency somewhat happy. But transparency leads to the confidence that makes people trade actively. And innovation. I mean, that's kind of the name of the game. That's what will keep us kind of moving forward into the future. So, and then this is a breakdown of last year's who was here, and I'll do another one this year if I can get a hold of data. It's interesting. I mean, that is our market. That's who we are. I'm in the service provider side, I guess. It's interesting to kind of see if that if we can get the buy side part to go up, maybe the exchange part to shrink a little bit. Although I like all the people who work for the exchanges. The question is, you mentioned minis as tried and failed and eliminated. In your opinion, what else needs to be eliminated? I would delist 1,000 stocks that don't trade and figure out a way to quickly get something back if it becomes a hot name. That's a start. And then you would see this 900,000. I mean, just think about if you're, from a liquidity side, if you sit down with your technology team and say, okay, what do we need to do to quote 900,000 options simultaneously? They say, okay, well, we're going to get 4 cages at Equinex for 40 grand a month. And, and from there, it's just up. So, capacity takes resources. And if we're listing these things, they're not trading, nobody cares, why are we listing them? So I hope that was illuminating thank you guys, and I look forward to hanging out with everybody the rest of the conference. Thank you.
Thanks, Henry. Good job. Thank you.
The preceding
Henry.
program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.